Okay, in this video, we're continuing our discussion of AUC Section 315 for understanding the entity and assessing the risk of material misstatement. And in this little series, we've been going through understanding the entity's internal control, and that involves understanding the components of internal control. And in the last video, we talked about the first component, which was the control environment. And in this particular video, we're going to be discussing the second component of internal control, which is the entity's risk assessment process. And so when we're gaining an understanding of this component of internal control, we should obtain an understanding of whether the entity has a process for identifying business risk relevant to the financial reporting objectives, estimating the significance of the risks, assessing the likelihood of their occurrence, and deciding about actions to address those risks. So in general, we're trying to understand, do they have a process for identifying what their risks are, and then do they do anything about it? And this would in general be their a risk assessment process. So if it turns out that they do have these things in place, and so that would mean they do have an established risk assessment process, then we should obtain an understanding of it and the results thereof. And so, of course, throughout our audit, we will be identifying risk of material misstatement. And so as part of this, we would like to see that the entity also identifies those risks as risk of material misstatement in their risk assessment process. If they haven't, then potentially there are some weaknesses in their risk assessment process. And that might lead us to identify a significant deficiency or a material weakness in this particular component of their internal control. And of course, if that leads us to determine that the entity doesn't have a good risk assessment process, then that affects our the risk that we identify in our audit. And perhaps from the perspective of the audit and the financial statement level risks, maybe there are risk of material misstatement throughout the entity's financial statements just because they don't have a particular risk assessment process in place that's effective to prevent those mistakes. So we've got some explanatory material here at A90 through 91 and A92, so we're going to go down and take a look at those items. Okay, so now we're down in the explanatory material section for the entity's risk assessment process, which we were talking about just a second ago. So here they explain exactly what the entity's risk assessment process is. And it says that for financial reporting purposes, it's identification, analysis, and management of risk relevant to preparation and fair presentation of the financial statement. And so it says that if the process is appropriate for the circumstances, for instance, related to the entity's nature, size, and complexity, then it would assist us in identifying risk of material misstatement. So for example, once we gain an understanding of the entity's risk assessment process, it might show how the entity addresses and considers the possibility of unrecorded transactions, or identifies and analyzes significant estimates that are recorded in the financial statements. And so based off of that, we would be able to gain an understanding of how the entity looks at these complex accounting transactions and be able to assess whether we think that the way they've treated the transactions is appropriate. And also down the road, help us to develop and design the additional audit procedures that we want to do. And so the risks relevant to financial reporting could include external and internal events and circumstances that may occur and adversely affect an entity's ability to initiate, authorize, record, process, and report financial data consistent with the assertions of management and financial statements. And those risks can arise or change due to the following circumstances, which might be changes in the operating environment, new personnel, new or revamped information systems, rapid growth, new technology, new business models, corporate restructuring, expanded foreign operations, new accounting pronouncements, and changes in economic conditions. So each of these things might cause some complexity in the organization that would turn normal routine transactions into very complex transactions. And that would, of course, be a risk to the financial reporting.